How long can you ignore a glaring red flag? Back in January, on the 27th exactly, I analyzed the TSX, the Nasdaq, the Dow Jones, and the S&P 500 using the standard deviation, which is a tool that shows how far markets have strayed away from their historical trends. Now, at the time, each of these indices weren't just expensive, they were actually extremely stretched when it comes to valuations, well above their normal historic averages. I warned at the time that markets rarely stay stretched at these extremes for a long time and that some level of correction was likely. Now, my update in April showed that the markets did in fact pull back. You can see on the chart here. You can also see, though, that since early May, it's been all uphill since then. So again, I asked this question: how sustainable are these levels that we find ourselves at today? It is August 11th, 2025. I want to reassess. And first of all, I want to look at a chart here you've probably all seen, the CAPE chart, cyclically adjusted price to earnings ratio. Today, we're sitting at 38.45. And you can see here, this chart goes back to 1871, and very few times, twice, has this ratio been so high. 1999, many of us lived through that, and then 1929. Again, today I'm going to look past the CAPE chart here. I'm going to analyze these markets through another lens of valuation, and that is called standard deviation. I'm going to use that as our key measure today. And this will help us understand just how far the indices have strayed from their historical norms, whether we should be concerned about another or an eventual correction. So when we look at the bullish momentum here, it has been strong, no question about it. The markets, though, have never stayed overvalued forever. They always, at some point, will revert to the mean. The question is just when. We don't know when that's going to be. So I'm going to look at the data, see what it tells us right now about the risks, and importantly as well, the likelihood of future returns. I just want to step back for a moment, talk about quickly what is standard deviation. And this is a statistical measure. It measures how much a market deviates from its historical average or its mean. And it helps investors gauge whether a market is overvalued, fairly valued, or in some cases undervalued. And I said in the first video I did in this series, I like to think of this as a rubber band. When it stretches too far from the average, the mean in this case, it eventually will snap. And that is exactly what standard deviation measures: how stretched the market is compared to its normal range. When you use this for interpretation, a standard deviation of 0, that is the historical average price level of the index. If you have a standard deviation of plus or minus 1, that is moderately above or below the average. It is still within, though, a normal range. Now, when you go to 2 standard deviations, that is significantly above the normal ranges. So above or below, if it's a standard deviation of minus 2, often that will signal either overvaluation or undervaluation. In the case I'm going to look at today, clearly the risk of a correction. So if you want to use this to apply it to investing, when markets are trading above the 2 standard deviation level, that means, as we saw from that first CAPE chart, they're historically at high valuations, and that means that the risk of a correction or, at a minimum, reduced future returns is elevated. The markets, the closer they are to the mean or below, that tends to offer better long-term investment opportunities. Investors should make a call, and they should balance their risk versus reward, considering how far an index has moved from its historical trend. Now, in the first video I did on this back in January, I went into some more examples of this. The dot-com bubble I covered, the housing bubble, the financial crisis. I will put a link here if you haven't been exposed to this metric before and you want to go back and have a look at some more examples there. The bottom line, this is what we're going to cover today. Investors should be cautious during times like this, and they have to recognize that there is an increased risk of market correction. So let's look at where we are today. First of all, the S&P 500. You can see 6,396. The mean level, the average level, 3587. 2 standard deviations above norm is 5,968. So you can see how we are today in comparison to that. So some key observations that I'm making. First of all, the S&P 500 is trading well above that plus 2 standard deviation level. To me, that indicates that we are at an extreme level of valuation. Historically, when we look at these valuations, the sustained moves above the 2 standard deviations are very rare. They are often followed by major corrections back towards the mean. The current level, roughly 78% above the historical mean. That tells me that the markets have run way ahead of the fundamentals. So as an investor, what do you need to know? First off, the risk-reward balance here is very unfavorable. Future returns will likely be lower from these levels. A mean reversion, that would imply a decline of about 44%. And investors here should probably consider taking some profits, rebalancing portfolios, or perhaps adopting a more defensive stance. And a quick reminder here, I can't advise you what to do directly. I don't know your risk tolerance, your risk profile, what your objectives and goals are, but I can share my thoughts, and these are some ideas that I'm implementing in my own portfolio. Now, the Nasdaq 100, current level 23,666. The mean level here, 11,008, plus 2 standard deviations, 21,548. So my main observations here, you can see this NASDAQ far exceeds that plus 2 standard deviation level. That makes it the most overvalued major index that we're going to look at today. The index is trading at a 115% level above its mean. That says extreme valuation. When we look back and use history as a guide, we see the overextensions to this level. They have preceded significant market pullbacks. Again, I'm looking at that 2000 tech bubble as an example. For an investor, based on history, you have to be prepared for a sharp correction. And in this case, the NASDAQ, like I say, carries the highest level of downside risk right now. If we see a reversion to the mean, that would be a decline of more than 53%. So that is a massive potential drawdown here. If you're a long-term investor, you might want to consider exercising some caution right now. Now, the Dow Jones Industrial Average. Currently, you can see the level here, 44,000 and change. The mean, 29,193. And 2 standard deviations, 44,552. So my main observations here, the Dow is currently just below that plus 2 standard deviation level. So that shows that there is a high, but slightly less extreme valuation than we see in the Nasdaq and the S&P 500. Current valuation is about 51% above that historical mean. Again, that means that the case for a mean reversion is still pretty significant. Difference here from that NASDAQ, the Dow has a more stable composition. History does suggest, though, that corrections from this level are likely. Implications for investors. As I say, the Dow isn't as stretched as the NASDAQ, but the evaluation still suggests that lower future returns can be expected. Even a move back to the plus 1 standard deviation, that would mean about a 16% correction. A full reversion back to the mean could lead to a 34% decline from where we are today. An idea, investors should consider diversifying out of the overvalued stocks and into some areas that have better valuation metrics right now. Now, here in Canada, the TSX, current level, 27,800. Now, the mean level here is 18,141, and you can see the plus 2 standard deviation level just over 25,000. So I see here the TSX is above that plus 2 standard deviation. Again, like the others, this tells me that it is significantly overvalued. It is about 53% above the historical mean. So that is a very sharp premium to historical norms. The TSX is more of a resource-heavy market, so the valuation here will depend more on commodity prices and macroeconomic factors. So as an investor, if you look at a pullback even to the plus 1 standard deviation, that would mean a 22% drop from current levels. A full mean reversion would be a 35% decline. So investors in Canadian equities may again consider taking some profits. And given the TSX dependence on commodity cycles, a slowdown in global demand, that could accelerate a correction. You're susceptible to that here. When I look at everything so far in aggregate, all the major indices definitely remain well above historical means. The Nasdaq, the S&P 500, as I showed, particularly stretched right now. The Nasdaq 100 is the most extreme. That's trading at a valuation of more of 100% above its mean. S&P 500 remains deep into overvalued territory. The TSX has joined it as well more recently at that plus 2 standard deviation. The Dow, of the 4 I'm looking at here, that's just under that plus 2 standard deviation, less stretched than the others, but still very high when you look at historic valuations. In all of these cases, a reversion to the mean would result in significant drawbacks, somewhere between 30% and 50% depending on the index. So the bottom line here is that the valuations that we're seeing today, as exciting as it has been to be part of this bull market, they're not sustainable forever. Now, if there is one lesson that we can take away from this video that history keeps teaching us, is that the markets at some point will always come back to their long-term averages. That's the way it works. The only unknown we're dealing with right now is how sharp that return will be, how quickly that'll happen. So for investors, this means that you can expect more modest returns going forward. If you buy at these heights, usually that's going to come with lower long-term rewards. The higher we climb, the steeper that slope gets. Prepare for volatility. The pullbacks are normal parts of the cycle. They are inherent in the cycle, but they're still going to hurt if you're not prepared psychologically for them. Manage your wins. If the portfolio is sitting on strong gains, think about at least rebalancing, maybe trimming some positions, or at least having a defensive play ready. Again, I can't tell you what to do, but these are some things that you might want to think about as you're managing your portfolio. And lastly here, bull markets, they do not run forever, right? Please leave your thoughts in the comments. What do you think about the markets, the way they're valued today? As always, I do appreciate you watching this video, and we'll look forward to seeing you in the next one.